What's up, everyone? Now, I'm sure if you're an investor, then you already know that Donald Trump has announced, or the US has announced, 25% tariffs on Canadian and Mexican goods and 10% tariffs on Chinese goods. And Canada has already issued retaliatory tariffs on US goods, 25% as well, on about $150 billion worth of US goods. As of the time of the recording right now, Mexico and China has not responded yet, although by the time you watch this video, they may have responded. But basically, we're now going to get a full-blown trade war, the biggest trade war we've had since 1930. And guess what happened around that time from 1929 to 1932? It was the biggest bear market in history, all right? The Great Depression, which is why I've been going on more than a month now talking about how we're going to get a major bear market because we have all the correct conditions in place to trigger off a big bear market. The number one thing is an overvalued stock market, which is why Warren Buffett has now sold half his entire portfolio and is sitting on around 36% cash. And the other factor basically is just having a very, very good trigger, bad news, and a trade war where the US puts 25% tariffs on imported goods is definitely going to spike inflation. And I would not be surprised if there's a huge spike in inflation again. We get back to like the 6-7% on CPI that we were getting during the COVID era. And then the Fed will not only not be able to lower interest rates, but will have to hike interest rates again later on this year as the data comes through. And I think we'll be able to see the data coming through very rapidly in March and April, which shows a huge spike in PPI and in CPI. Okay, so I will admit when I am wrong, and for the last 2 or 3 weeks, I've made videos where I said that I expected the market to melt down, and not only did the market not melt down, it traded back up. And in fact, some of my short trades during the last 2 weeks got stopped out. So I made a loss. On the Monday, on the Sunday night, when futures opened, it started tanking because of the DeepSeek news, how basically Chinese company was able to make an AI model much cheaper than the US versions like ChatGPT. And they say they spent 5.6 million, which is BS, but they must have spent way more. But assuming even if they spent $500 million, it is still way cheaper than the $500 billion, which was earmarked for Stargate. That scale of investment is no longer going to be on the cards. So all the AI stocks are way overpriced and should be coming down. And as I mentioned before, Tesla and Apple are way overpriced. And if this trade war triggers off what I expect it to do, which is basically pop this bubble and the Fed will have to raise interest rates, then the stock market will come down a lot more. Okay, so let's look at some of the key levels on the stock market, right? So if you look at the NASDAQ 100, which I shorted on the Friday before the close and even before the tariff news came out, so I was quite lucky. So I shorted again on the NASDAQ, even though I made money on the Monday and I started losing money on the Tuesday, Wednesday, Thursday, because the market traded all the way back up and it kept on hitting my stops on every day. But on the Friday, I was just like, no freaking way, the market is not going to sell off again. And I shorted again on the NASDAQ 100 at 21,780. And then the tariff news came off. So before the close, the market came down about 300 points and erased the gains that it had and was in the red. And over the weekend, right now on IG weekend NASDAQ futures, the NASDAQ futures are down almost 400 points at the time of this recording, all right? So I'm like 700 points in the money, and I'm quite happy about that. Now, I expect that if the NASDAQ 100 falls with the same basically volatility, the same downside percentage-wise as what we had in January 2022, then for the entire month of February, we can fall up to 15%, okay? So this monthly bar for January 2022 is a 15% fall, which means that we can fall around 3,000 points on the NASDAQ 100 if we get a repeat of that based on this tariff news, okay? Obviously, it is possible that the market holds key support this month, but I think it's highly doubtful because we've already held a 300-point range on the S&P 500 in December and January, and based off this news, I think we're going to have a much bigger range in February to the downside than the 300-point range we had in the last 2 months. And that would mean that we break key support level around 5,770 level on the S&P 500, which means that we will accelerate to the downside for the general market. And I think the tech stocks will fall the most, which is why I'm short the NASDAQ 100, right? And I still have my short from 6,010, which I've told everyone that I'm going to keep for 18 months, all right? So my big short position right now is in NASDAQ 100 from 21,780 and a small short position at 6,010 on the S&P 500, okay? And if you look at the Dow, it's actually made a really, really big double top formation. And if it breaks the neckline of the double top formation in the middle between the two heads, then we should fall basically to around just under 40,000 level on the Dow, okay? But that just shows basically how much room we have to fall, which is quite a significant level, okay, if the Dow falls back to close to 40,000, which means that the NASDAQ 100 will most likely fall close to where it fell in August last year, where if you see there's a nice support level around the 18,400 level, right? So that's what I expect for the first leg down in the bear market, and then we will get a bounce from that level, okay? And you can see that basically in the charts of a lot of bear market charts is that you get a first sharp leg down, then you get a rebound, which is a wave 2 rebound before the big leg down on the wave 3, all right? So I would expect after the big sell-off in February, it might go into the first half of March that we have a big rebound in March, but not back to the highs, obviously, okay? Just like retrace maybe a third or even half of the fall. And the market stabilizes for 2 or 3 months before we get a big downside, okay? And then who knows what will happen in the next 2 or 3 months, but the inflation will definitely pick up, and then basically the economic data I think will get really bad if the Fed starts hiking interest rates and growth slows down while inflation speeds up, okay? So just to give you an idea of how bad these tariffs are, in 1930, after the Wall Street crash of 1929, the US government, basically the Congress passed what was called the Smoot-Hawley Act of 1930, which is basically the US taxed, put tariffs on imports from everywhere else, and then European countries basically retaliated and put tariffs on US goods, and global trade ground to a halt. And then the Great Depression got way worse for the next 2 years, okay? And that was when global trade was not as big as it is now, right? Global trade is actually huge, and the US gets a lot of its raw materials from Canada and also from Mexico. So the fact that, you know, there's 25% tariffs is just a tax basically on actually US citizens, okay? It's not gonna be a tax on basically the foreign countries. So, you know, the fact that we have this precedent in history, like from the Great Depression, just shows how bad these tariffs can be for the markets. And plus, as I mentioned before, Warren Buffett has sold 50% of his portfolio now. Okay, that actually made the news, and he's up to 36% in cash, which is the highest he's ever had. And he's not doing selling because he's just going to be trading and buying back next month. He's sold so much of his portfolio because he obviously sees that the stock market is way overpriced, okay? And one metric that everyone should take a look at is the buffet indicator, okay, which is basically shows how the Russell 2000, which is basically the broad index of all the listed stocks, is basically 66% overvalued compared to the actual GDP of the US. And how if it's 66% overvalued, then the market should come down by about 40% to bring it in line with where it should be compared to GDP, okay? And Warren Buffett came up with that indicator back in, I think, 2000 or 2001, right after the dot-com bubble burst, to basically, because back then was the last time the market was so overvalued, all right? And again, the market right now is the most overvalued it's been in 25 years, which is why it is so prone to turning into a major bear market, all right? If the market was like, if the S&P 500 was at 3,000, if it wasn't overvalued and there was a trade war, then the market will most probably shrug it off. But the fact that it is very overvalued now means that we have a huge downside potential, which is, again, I'm like when I make these videos, I can't give recommendations for anyone to sell or short. I'm just saying that basically on Friday, I went in with around 66% margin of the amount of money that I can use to short. Okay, gave myself some breathing room in case the market went up even higher. I'm going to go full margin with the rest of my money when futures market opens on Sunday night. I am that confident that we're going to get a big meltdown in February. Okay, and I expect around a 15% fall from the highest point, from the close on Friday down to the lowest point on February. And we might get a rebound at the lowest point, obviously, and we might not close there, but from the top to bottom, I expect a 15% fall, which would mean around probably a 10% fall on the S&P 500, and we go into correction territory before we bounce. And the next leg, we won't go into bear market straight away. The next leg down will be when we get a real bear market and when it goes really, really deep. So just be cautious. Know that the market is 66% overvalued according to Warren Buffett, and that the last time the world had such a big trade war was in 1930, and it made the Great Depression much, much worse, all right? And we're in the same scenario now, okay? So anyway, good luck trading, everyone. I'll definitely be short on the Monday, but again, to my friend who does options, stop doing options, because most of the move to the downside is already done in the futures market overnight, and by the time the options market is open for same-day options, it might already be the low of the day, all right? So I would strongly suggest anyone who wants to short straight off the bat Sunday evening futures opening, okay? All right, good luck.